Introduction. Understanding deflation, the economy, is like a living organism. Sometimes it grows, sometimes it slows down. But there are times when prices don't go up, they go down. This period is known as deflation. At first glance, it might sound nice. Bread is cheaper, electronics are sold at lower prices. But behind the scenes, deflation is actually a warning sign that the economy is in trouble. Why? Because falling prices lead to declining company profits, reduced investments, and rising unemployment. People start thinking, maybe I should wait, things will be even cheaper tomorrow. And this vicious cycle slows the economy down even more. In history, Japan entered a long deflationary period in the 1990s, known as the Lost Decade. Prices kept falling, yet the economy failed to recover. The United States experienced the devastating effects of deflation during the Great Depression in the 1930s, and our story begins in such a challenging period. Part 2. The story begins. Daniel and Laura were two friends with savings of $50,000. Both were in their early 30s. College classmates, but they saw finance differently. Laura was cautious and avoided risk. Daniel liked chasing opportunities. One day, news reports confirmed that the economy had entered deflation. Prices were dropping. The market was sluggish. Unemployment was rising. Companies were downsizing. Laura said, maybe we should just keep our money in cash until things stabilize. Daniel replied, deflation isn't just risk, it's also opportunity. And so, the two friends decided to come up with a plan to make the most of their money. Part 3. The strategy. Diversification. Their first rule was simple. They wouldn't put all the money in one place. In deflationary times, risk management is everything. Their plan was to split it across for investment types. High-interest savings accounts (HISA), defensive sectors dividend-paying stocks. Investment-grade bonds, they would invest in each and check the results after 1 year. Part for a deep dive into HISAs, they put $15,000 into high-interest savings accounts. These accounts were a safe haven, government-insured, with high interest rates. In deflationary times, inflation is low or even negative, so the real interest rate increases. For example, a 4% interest rate with 0% inflation means a real gain of 4%. After 3 months, they had earned $150 in interest. No risk involved. Laura loved this part. It provided security. Part 5. Defensive sectors. The economy's strongholds, they invested $12,000 in healthcare, food, and mining companies. These sectors maintain demand even in a crisis. Hospitals don't shut down. People still eat, and certain raw materials are always needed. Daniel researched how defensive sectors had performed during crises over the last 20 years. The results were encouraging. After 6 months, their portfolio was up 12%. They had made $1,440. Part 6. Dividend-paying stocks, they put $10,000 into banks and insurance companies known for paying regular dividends. These companies distribute a portion of their profits to shareholders. In deflationary times, this steady cash flow is extremely valuable. Even if the stock price doesn't rise, dividend income still puts money in investors' pockets. After 1 year, they earned $800 in dividends and another $500 from stock price appreciation. Part 7. Investment-grade bonds. Safe debt instruments. They invested the remaining $13,000 in investment-grade bonds. These are low-risk debt securities issued by governments or large corporations, with a fixed annual return of 3%. They earned $390. Part 8. midway reflection, and investor psychology while the investments were growing. Lavra sometimes worried, what if the market never recovers? Daniel would remind her, the real danger is letting your money sit idle. Safety and returns can go hand in hand. Part 9, Year-End Results HISA, $150 defensive sectors, plus $1. 440 dividend stocks, plus $1,300 IG bonds, $390 total profit, $3,280 annual. Return, 6.56% in a deflationary period. This was a solid success. Most people who stayed in cash had actually lost purchasing power due to opportunity cost. Part 10, Key Lessons Learned. Deflation is not always a disaster. Diversification reduces risk. Defensive sectors, dividend stocks, and safe bonds can still deliver returns during a crisis. Steady cash flow provides psychological comfort in tough times. Lavra said, I was scared at first, but I'm glad we acted with a plan. Daniel smiled. No matter what the economy looks like, knowledge and strategy always win, and that's where this story ends. But in real life, for smart investors, deflation is just the beginning of new opportunities.